Hi everybody, and today you've got two members of the Economic Advantage team, Anthony Cross and I'm Matt Tong, and today we're going to give you a quick spin through the Liontrust Special Situations and Liontrust UK Growth Funds. We're into Q2, the tulips are out, and most companies have now reported on their 2023 results and crucially given us a little glimpse into what might happen in 2024. There are three main messages. First, the size backdrop is again having an impact in 2024. Trading has overall been resilient, and finally, valuations are still looking compelling, so it's not too late to invest. On the first, size, and here what we mean is the divergence between big companies and small companies. Now, if you cast your mind back to 2022, on average, if you recall, the top 10 stocks in the FTSE are up over 20%, and the return of everything else was down over 10, and AIM was down near 30%. So 2022 was the revenge of the large caps. Last year, thankfully, markets recovered, and if you looked across the main FTSE indices from the small to large cap, they were all up about 8%. There was one outlier though, AIM was down 6.4. Year to date, what we're seeing again is a little like a rerun of 2022, but without the aggressive moves thus far. So the top 10 stocks in the FTSE are up 5%, the FTSE 100 is up 2%, mid cap and small cap are down 1.5%, and poor old AIM is bringing up the rear down 2%. It's therefore no surprise when you look at our two funds that the UK Growth Fund is outperforming Special Sits year to date, as UK Growth has about 70% in the FTSE 100, Special Sits has only got just over 40, and the AIM weight 7% in UK Growth and over 20% in Special Sits. So that's the divergence in performance we're seeing. It's also worth noting, if you look across sectors, the banking sector is up 7%, and those of you who invest with us will know we don't invest in banks. So again, we're seeing a little bit of a headwind from that sector performing well.
So despite being a tough economic environment, the trading performance of most companies has been pretty resilient. The engineers and the oil companies have been reasonably solid. The software and communication companies like Sage Group, Craneware, Digital and Gamma, with their recurring income, have delivered, and those media companies with a strength of must-have data, such as Relex and Global Data, have done well. The pressure points have been felt by some companies where there is a definite discretionary element to their demand, such as Focusrite in audio and production equipment, and the recruiters Robert Walters and Page Group. Now, we had a really good meeting with Page Group the other day. The scale of its global footprint is certainly relevant to its large multinational clients. And their technology platform, which can handle 1.5 million CVs per month, gives them significant advantages versus smaller competition. Their focus, and it's always been a focus, on organic growth and the strength of culture within the business has been a really key part of growing their network of now over 2,000 teams. Cyclical, certainly, but a quality cyclical, which should reach new highs on the next economic upswing. Now, Reckitt Benckiser is definitely worth a mention. This is a company that has not covered itself in glory over the last few years. Too many missteps, and the acquisition of Mead Johnson, the infant milk business, has been a real value destroyer. What we weren't expecting was the litigation blow that the company experienced in March. We have now sold our shares, and there were two real drivers surrounding this decision. The first was the potential financial risks surrounding the litigation. The sums involved could be significant, and the timing, certainly, of any legal outcome are likely to be quite drawn out. The second driver behind selling the shares was the very simple fact that there is a compelling opportunity cost. Whilst a case can be made that the fall in the value of Reckitt's share price is overdone, there's plenty of other stocks we own where valuations are very low and their potential upside is not clouded by such a degree of uncertainty.
It can't escape everybody's notice watching this video that valuations in the UK continue to look compelling right across the market. We'd agree with that. Without going into great detail, instead I'm going to point you to a video I did interviewing the Quest team, which is on our website. Just to give you an update on that, the message today is still the same. On their latest numbers, the UK looks 22% cheap versus fair value and at a 25% discount to where it normally trades. And the UK smaller companies market is even more compelling, at a 38% discount to fair value and at almost a 60% discount to where it normally trades. Obviously, small caps normally trade at more of a premium to fair value than large caps. Small caps, therefore, seem to be where the biggest opportunities are sitting. And judging by the many interactions Ant and I have had with clients at the start of the year, it's certainly an area a lot of fund selectors are asking us questions about. Tell me about UK small cap, tell me about the opportunities. Companies themselves are also telling us their shares is cheap. Indeed, last week we had a really interesting meeting with the head of the renewables business at Shell, and he also runs their downstream operations. So to give you an idea of the scale of that, that's 6 companies he's running, which if they were listed would all be in the FTSE 20. So this is a really big job. The message here from Shell was that they think their shares and stock looks very cheap. Indeed, the CEO has been saying the same thing in the press, and they're going to continue to use their massive cash flows to buy it back. Some other interesting nuggets from that meeting I enjoyed were Shell are apparently the largest retailer of Coca-Cola and Red Bull in the world via their network of 46,000 convenience sites, which is more than McDonald's and Starbucks. They're the second largest EV charging provider in the world, second only to Tesla, 33 million customers a day. Just reminding us all that Shell aren't about oil and gas, and totally, they're also about energy transition. And this is even without mentioning the fact that their liquid natural gas network is the largest in the world. It's really no wonder that last week, the former US Undersecretary for Energy for Science from the US wrote an open letter inviting BP and Shell to move their headquarters to Houston and listings to the US. US oil companies trade at about 100% premium to our ones. Shell indeed aren't the only companies buying their stock back. Many of our companies are taking advantage of their low valuations doing the same thing. And in our minds, that's a sensible capital allocation for management teams.
Finally, we're very excited that Alex Game will be joining our team in May. Now, he comes with a wealth of experience of investing in small and mid-cap stocks. And we've been really, really chuffed by the amount of emails that we've had from clients saying what a great guy he is and how much they've enjoyed working with him previously. It's really been important to us that we've been alive to bringing fresh talent into the team and to ensure that we're resourced for future growth. So thank you for watching our video today. It was a short video, a nice short update, but if you want a longer meeting, you want to be in touch with us, please do. We love seeing clients. We're always open to talking to people, so please get in contact with your sales representative at Liontrust. All the best and have a good early summer.